monthly wrap-up. We'll be covering the month of March 2020 and a bit of April, given that markets are moving so quickly. I hope you're handling the lockdown well. As you can see, we've got a bit of a different background here because we are recording this video from home. Corona is the main word that's in everybody's minds at the moment, and it's had a dramatic effect on markets globally. However, there's two other factors that have almost been dwarfed by the coronavirus, one being the oil wars between Saudi Arabia and Russia. We've seen the oil prices drop to almost $20 a barrel. And then the third one, which is something of more importance to South Africa, is the final downgrading by Moody's of South African government debt to junk status. The junk status was something that was expected. It maybe added more volatility, and we've seen the rand weaken, although the main reason for the rand weakening has actually been the global turmoil. And the reason we know this is we can see that it's been moving in tandem with a number of other well-traded emerging market currencies. The coronavirus has seen markets unsure of what the value should be of shares, and we've seen share prices around the world fall dramatically. At one stage most markets were down between 30 and 40% during March. We have seen some bounce back from that. But having said that, if we look at the South African equity market, was down over 12% for the month of March. Global equities were also negative for the month, and that was despite there being a 15% weakening in the Rand US dollar exchange rate during the month. So there was nowhere to hide in terms of performance for the month, and you'll see that when you have a look at your statements. If you look at them to the end of March, you'll see, as we highlighted in the previous video, that the markets in March were particularly bad, and when you've got long-term portfolios, one cannot hide from that. As investment advisors, one of the key things that we are trying to do constantly is understand the markets based on the research that we're able to do. Now, there's really three main things that drive markets, and the first two we've spoken about many times. The one is valuation. Is a share or a bond cheap or expensive at the moment? If it's cheap, it's more attractive to buy. You expect the returns to be higher in the longer run. Secondly, are the returns that we expect from that company, for example, are its profits, are they going to grow into the future? If it's a bond, is the interest I'm going to earn on that bond going to be attractive into the future? Now, the third one we don't speak about often, and that is liquidity. And the reason being is that liquidity affects more the short-term impact of an investment. And if we have a look at times of stress and crises like we're in at the moment, liquidity often dries up, and that then causes the valuation of whether it's a share or a bond or a currency to go to unreasonable levels. So it becomes too cheap, for example, as a share, because people are just dumping that share and prepared to take whatever price they can for it. Because there's low demand for it and an oversupply, the share price or the bond price then falls beyond a reasonable level. Now, we're not suggesting that the world won't be affected by the coronavirus. It will. 2020 is likely to be a year of recession globally, but there is life after 2020. Economies will adapt, companies will adapt, people will adapt, and we've already seen that in some of the countries that have been through the worst of the coronavirus in their countries, where the economies have improved already and the economy is working again. And we expect to see that globally. Some countries will be better off than others, some companies will be better off than others. And it's really about having a portfolio that has exposure to growth assets in the long term, for which you will be rewarded by having those in your portfolios, because you'll see a correction in prices, and you'll be rewarded by having investments in good companies, and especially if you can buy them at good prices. We're going to touch on a couple of questions that we're receiving quite frequently at the moment. One of them is, how bad is this crash compared to previous crashes? The 2008 crash, we saw the markets fall almost 40% at one stage. We haven't seen that yet. We've got close to it during the month of March, but we've actually seen the markets pick up subsequent to that. And as I said, the equity markets are down about just over 12%, the JSE, for the month of March. So we saw an improvement from the 19th to the end of March. The reason for the sharpness of the pullback and the preceding bounce is probably because of how quick information flows these days. Are we at the bottom? I can't tell you that. I don't know. There's a lot of volatility in the market. There's a lot of unanswered questions. We are starting to see the infection rates globally starting to flatten out, and the increase in infections pretty much across Europe, excluding the UK, is actually flattening now and starting to slow down, which is a good sign. We haven't seen that yet in the US, and I think the US and probably South America and Africa are still areas where one has to see this coming through. Another question that we've been asked is, well, what should I be doing with my long-term investment at the moment? Should I be taking my money out of South Africa because of the credit downgrade, for example? Our view on the currency at the moment is that it's actually gone too far. There's different mechanisms that we use, but if we look at those measures, the currency has actually got too weak. Now, we're not saying don't have offshore investments. In all of our portfolios, we have exposure to offshore investments. It's a wise thing to have a diversified portfolio that's exposed to different currencies and different markets around the world. But at these levels of currency, we think that the rand is actually too weak, and in the medium to long term, we would expect actually to see some correction. Another question we've had from some investors is, shouldn't I be piling in to the markets at these levels? And we are allocating, as clients who have additional cash are seeing how cheap the markets are at the moment, we are allocating those to particularly growth assets. But we're not doing it all at once, simply because we don't know whether the markets could still weaken further from here. So investors who are allocating capital to the markets at these attractive levels, we're phasing that in over a 2 or 3 month period. A recent analogy I heard from an investment manager was one of a tarantula on a table inside a glass jar. He then told someone to put their hand against the glass jar. As soon as the spider moved towards their hand, their natural reaction was to pull their hand away. And that's just a normal human instinct. And similarly, when markets fall this much, our natural instinct is to pull our funds away, to disinvest from the market. Whereas the rational approach is to try and understand what's driven the markets, understand the valuations on markets, and understand what the prospects are for the future returns of those portfolios. Now, as recently as this very last month of March, we can see exactly that playing out. If we had a look on the 19th of March, now with hindsight, was the point where the JSE was actually at its lowest in a number of years. Since the 19th of March to the 9th of April, the JSE is up over 27%. The global equity market's also up close to 20% over that period. And our bond market, which usually gives you a return of around 10% a year, was up 6% in the space of from the 19th of March to the 9th of April. Just showing that had investors disinvested at that point in time, just on reaction, on instinct, they would have actually locked in some material losses. Now, we don't know where the market's going to end, whether it's going to go down from here, but over the longer term, we can see that the prospects for long-term investments are still good from this point in time. And therefore, in a portfolio that's well diversified across countries, across managers, across asset classes, investors are well positioned from a long-term point of view. As always, if you've got any questions or you need to talk to somebody, please give your advisor a call on their cell phone or drop them an email and you'll be able to get hold of them. Thank you very much for watching. Stay safe, and we look forward to seeing you once the lockdown is over in person.